today's World Insight. Trouble with two big U.S. banks going belly up. Are worries over a domino effect warranted, or are the bank failures nipped in the bud? How do the bank runs affect U.S. efforts to rein in rising inflation?
Hello, I'm Tian Wei, and this is World Insight coming to you live from Beijing. Global markets remained volatile after the meltdown of Silicon Valley Bank and the failure of the New York-based Signature Bank over the weekend. SVB was the backbone of many startups and venture capital funds around the world. Thousands of technology companies are facing financial uncertainty after the failure of America's 16th largest bank. Although the Biden administration made efforts to shore up market confidence in the past 2 days, it failed to remove fears of possible bank contagion following the collapse of SVB, which is the biggest bank failure in the U.S. history since the year 2008 financial crisis. So what is next? Will the Fed ease up on its interest rate increase to take the pressure off the banking sector? And how much could the government do to regulate and protect the banks? For answers, let's loop in our panelists. In Los Angeles, William Li, chief economist with the Milken Institute. In Beijing, Michael Powers, Zurich Insurance Group chair professor with the School of Economics and Management of Tsinghua University. Gentlemen, welcome to the program. News are moving very fast as we speak. The opening today of the stock market, where they see the Credit Suisse Bank in dealing with one of its largest crises in years. So, Professor Powers, tell me more about your thoughts. Down 30% already at this point.
Well, I imagine that we will continue to see the bank stocks will continue to take hits, and not just Credit Suisse in particular, but other ones as well. They already have been affected by this crisis. I think that what people are looking at is, are there particular banks, for example, is Credit Suisse one, that are particularly vulnerable at this time?
Of course, Mr. Li, the Credit Suisse problem at this moment seems to also has something to do with the sources of the money. For example, the Saudi National Bank saying we don't have enough cash for this anymore. So how should we look at the overall picture? It's not just Credit Suisse, it's a bigger picture, as Professor Powers just mentioned.
Well, I think in the case of the Silicon Valley Bank, we have to remember that was a very specialized bank. In the old days, in the 19th and 20th century, it would have been called a regional industrial bank, where it would specialize in a special sector of the economy called startups and high-tech industries. And when the industry itself goes down, the bank itself is also threatened because it is so concentrated in its business. In the case of Credit Suisse, it's been well known that that's been a troubled bank. And so what we have here is a sequence of reports where market and investors are probing the banking sector to see where the weaknesses are, and where there are known weaknesses, they really attack the companies, because they're testing to see whether regulators and supervisors are in a position to try to support the banks and bail them out, or will the shareholders be the ones who take the hit? And I think that's the way the banking system has always worked. Since 2008, in the United States, there have been over 500 bank failures, and none of them have been systemic.
Of course, earlier we have seen that the U.S. Suggesting it's supporting the bank SVB, but did not say the word bailout, of course. That seems to be a very interesting phenomenon. Go to you, Ms. Wang, in Shanghai for us. Tell me more about your thoughts about, is it another sign of contagion in the financial market when you see what is happening to Credit Suisse Bank today?
Regardless what the Federal Reserve or the Treasury want to call it, this is a bailout. And the shareholders and bondholders' value have been zeroed. So that's potentially a cushion for some of the loss that banks have been incurred. But overall, the contagion is quite limited because the regulators have swooped in and there are potential buyers down the line.
But when we look at what is going on with the banks around the world today, the stock market at least, you see not only the so-called second-tier banks like in the United States, but also Credit Suisse, which is an international one, certainly based in Europe. We also see the down of the stocks by some of the major banks in the United States, Bank of America, and the list goes on. So are we seeing contagious phenomena? Do you see it is contained? It could be contained, Professor Powers?
Well, I think that by and large it will be contained, but I would agree with what William Lee said just a moment ago. Investors are testing these banks. They are showing disfavor of if there are financial problems or some risky behavior that they think the banks may have been engaging in. But I think that when things settle down, what will happen is that we will identify those weakest banks. The herd will be thinned somewhat, but the actions of the U.S. federal government probably will stop this from becoming a major financial crisis.
But you're already kicking the can down the road, Professor Powers, suggesting about quite a long time from now. But what is going on right now will have a huge impact on what is going on in tomorrow or next year. Remember the financial crisis, and God save us, we're not going to experience one of those. But remember the financial crisis, the Lehman Brothers fell down a year before the financial crisis happened to the rest of the world. So we are not going to likely to see the light of the tunnel immediately. At least that seems how things work. Professor Powers, very briefly from you before I move on to the others.
I agree, actually, and the phrase kicking the can down the road, unfortunately, that's a very good description of the American financial services regulatory system. It's, deal with the crisis, pass a law, repeal the law, deal with the crisis, and so forth, treating every situation as new and unique.
Since you bring the United States into the topic, let me ask you, Mr. Lee, about that. You are working for an investor, a well-known world investor. So what about Dodd-Frank bill? As we know, after the global financial crisis put into effect and supposed to protect the banks in a way and also to tighten up the regulations against the banks for them to follow the rules. So is it the collapse of SVB in a way reflect problems with that act?
It actually reflects the failure of market surveillance, because the way the financial system in the United States works is that the top 5 banks have more than 50% of the assets of the banking system. So the assets are very concentrated. And those systemically important banks are always under very close supervision by the Federal Reserve and all the regulators. They're stress tested and they are really looked at very carefully. These smaller banks have been less regulated because the thought was that if people deposit money in the smaller banks and they're not protected by insurance, the depositors themselves should do what we call market surveillance and market due diligence to make sure that if you want to put money into a bank, you better make sure that you know what they're doing and they have good risk management practices. Silicon Valley Bank failed every one of those tests, and yet people deposited money with them because the startups felt that Silicon Valley Bank provided them the ecosystem that was so friendly towards startups. And that was a weakness and a vulnerability that we see has failed. So I think that in terms of contagion, you're right to say in 2008, we didn't know there was an AIG that was behind everything. We didn't know how networked the banks were together. What we've learned since then is to watch out for network connections that spread contagion. And the fact that we don't have a lot of spread to the systemically important banks tells us that the regulatory reforms are in place, are working, and that it is really the failure of supervision at the smaller, mid-sized level banks that is showing up now.
Well, Mr. Lee is talking about the U.S. system, but Ms. Wang, I want to go a little bit further to this part of the world. We also see the stocks of Asian financial institutions down over the past 2 days. Meanwhile, of course, when the economies were struggling after the pandemic, the financial institutions are all pretty weak at this point, so could be vulnerable than before. What do you make of what Mr. Lee and Professor Powers describe of the U.S. system? And whether we criticize that or not, how do you see the contagion effect could be contained, at least in this part of the world?
I actually don't see much impact on Asian market yet. Of course, the global financial system is way more integrated than before. Any changes in the US stock market would affect what's going on in China and in other parts of Asia. But still, the monetary policy here is in a very different cycle. If we look at China, actually interest rate is going down rather than up. So that in itself is a cushion already. And when we look at other Asian countries, they are even less susceptible to this kind of vulnerability because the startup is only a very small fraction of the high-tech sector in those countries. The regional banks are quite diligent when it comes to lending to them. So it is actually a unique feature for the US financial system to take on such kind of risks.
Very interesting. Professor Powers, your thoughts on what Ms. Wang just said?
Well, I would agree. I think that there will be some international ramifications. There certainly is some degree of fear in markets. I think some of the fear that we're seeing in stock markets is a bit irrational. But at the same time, it may make sense in that people don't know where things are going. And while there is some uncertainty, it might be better to move your assets into safer investments. So I don't see a problem. I don't see a major crisis spreading, but I do understand some of the behavior that we're observing at the moment.
Mr. Li? Mr. Li,
I think that Professor Powers just pointed out one source of contagion, which is that the source of contagion would be withdrawals from smaller banks to be put their money into safer banks. That kind of withdrawal could make worse the problems that are already existing in these smaller banks. So the source of contagion really is within the smaller banks. Will they be able to survive? Will their business models have to change, or do they need to be bailed out by and bought out by the larger banks?
One of the issues, a
huge consolidation within the smaller banks.
Right. I just want to follow up, Mr. Li. One of the issues that both the banks around the world and also the policymakers have to deal with now is fear. Now, the fear of consumers, the fear of those who put their money into the banks, whether it's a big bank or a small bank. So what about that fear factor? Are policymakers, do you see, are making efforts for that? Do you see it's sufficient? We heard about the situation in the United States, for example, the president and also the financial secretary coming out, but the Fed chairman didn't so far. So what does that say about what is going on there?
That's exactly the right question to ask, because there is no bank on earth that could survive a mass withdrawal of every deposit. And so containing people, right? The famous movie It's a Wonderful Life, where we see James Stewart, who was the head of the credit union, trying to calm people down, say, no, you really don't need to take out all your money, do you? That is what the authorities are trying to do right now, to try to reassure everyone your money is protected and money is safe, and to try to calm that fear, because the one thing that will destroy the financial system would be that kind of fear and people withdrawing everything, putting their money under the mattress.
But of course, the president of the U.S. and also the financial secretary coming out, they are political because they are working for a Democrat administration. But we don't see the chairman of the Federal Reserve coming out. Professor Powers, usually the chairman of the Federal Reserve would, under a crisis, for example, during the pandemic, to calm everybody down. But this time, not yet. Does it say the situation is not fierce for him to come out, or does it say he may have hesitations to come out, or the Fed might be having some big gestures the coming week when they're having a meeting?
Well, I suspect that he's working behind the scenes very frenetically at the moment. I don't think that he wants to make public statements, and that could be for any number of reasons. But there are two things that are quite obvious, and one is that everyone is speculating about what will the impact of this be on the inflation fight that the Fed has been engaged in. And there's a second aspect, which is that obviously as a result of this, one of the things that we've learned is that the Fed was not a very good regulator of SVB. The signs of this problem were very evident. And the fact that they weren't picked up on or acted on really indicates that the Federal Reserve Bank, as the primary federal regulator of the bank, was either asleep at the wheel or it really didn't it really didn't care, and it was so focused on bigger fish that it allowed this to happen on its watch.
Do you see that's what's happening, Ms. Wang?
Yeah.
Well, I actually think Fed did a pretty good job in regulating the American banks. Even in this crisis, actually within 35 hours, the Federal Reserve and the Treasury already issued a joint statement. So for all those depositors with SVB, they were only not able to access their cash in just one working day. So this kind of speed in policy response is already very remarkable. So I actually don't see much problem in the stability of financial system in the U.S.
Well, of course, Mr.
I
Lee disagree. I saw him already waving his head. But Professor Powers, if you want to, please jump in.
Yeah, I would agree with Wang Dan that the Fed was very good at cleaning up the mess. But there's another part of regulation which is trying to prevent the problem in the first place. And when you have a bank like SVB that grew so rapidly in terms of the deposits it was holding over such a short period of time, that's the #1 signal to financial service regulators that they should keep an eye on that institution. And they didn't.
All right, Mr. Lee.
That's absolutely correct. Professor Power was absolutely correct to point out a failure on the part of supervisors to catch what was already well known and in public information. In fact, that's why we had the run-on bank in SVB, because the private sector found out, my God, there was no risk management practice at SVB. In fact, there wasn't even a risk officer at the time. And so what that should have told us was that the state regulator, which regulates the bank itself, and the Federal Reserve that regulates the holding company, completely failed in the last year to notice that. And I think they got sucked into the culture of Silicon Valley, which is to say SVB is such a wonderful champion of startups and we should preserve that ecosystem. And I think the Fed is right to say we're going to do an investigation into the supervisors at the San Francisco Fed, at the California State Bank, and say what went wrong, because the public information was there, investors found out about it, and that's why withdrawals took place. But I think Wang Dan is absolutely correct to say the speed with which the system tried to correct itself and the response by the Fed to set up a lending facility was exactly lightning speed and was exactly what was called for, and they did a great job containing the withdrawals. But I think the failure is exactly what Professor Power said is with the supervisors.
Right, but on the other hand, Mr. Lee, if we already see Signature Bank also having similar problems, and once again, we hope the list will not go on, but it's very likely the list could go on. So what would that mean for the financial governance in a way? Does it mean that we're going to see more bailout without saying bailout? So that is really the question. And what does that mean for the others as well, outside the United States too? For Europe, for example, European Central Bank, what can they do? What are they going to do? Please, Mr. Lee, briefly.
You're absolutely correct to say that the fringes of the banking system that cater to cryptocurrencies, that cater to Silicon Valley, those are where we see the vulnerabilities because they're so concentrated in these fringe activities. But the core banking activities of lending to sound businesses is something that is going on very clearly right now and is very solid. And you're right to say Credit Suisse is also a problem because they also were engaged in bad lending practices, of bad risk management practices.
Okay, Professor Powers, I didn't see Mr. Lee answer my question directly, but please go ahead if you want to take an answer.
Well, I don't think that, as I said, I don't really think that this crisis is going to get out of hand, but I hope it's an opportunity for U.S. citizens and the government to improve the system. One of the big problems, and I think William alluded to this somewhat, is what we could call regulatory capture of the regulator. That is that these banks probably were treated with kid gloves because of relationships they had. So the SVB was a very important bank in California. Its primary regulator was supposed to be the state regulatory agency. I suspect that they weren't going to, they weren't in a position to give it too much trouble because it was of political significance in California.
Ms. Wang?
Oh, well, I think the real question is what Fed should do next to contain the further risks. Because previously the discussion was on how to insure the individual deposits, but for SVB, dominantly the deposits were from corporates. So what's the logic behind insuring individual deposits rather than corporate deposits? There is no real logic for that to happen. So there has to be some changes in regulation.
The other thing, of course, what we talk about now is the banks and the issues related to the banks, but bigger than that is an issue about the economies, because we know that the Fed is going to have a meeting coming week about the interest rates, and that will have a tremendous impact on not only the banks, yes, it is going to be on the banks, but also on other issues about the U.S. economy. The CPI is up, even though mild. We also see different debates around the world, for example, about the U.S. Fed raising the interest rates over the past years. And today we also see China, Saudi Arabia, for example, having a new deal on the RMB. So it's also related to the US dollar for the future. So we are seeing a very mixed picture about the immediate effect on the banking sector. We're also seeing it is mixed up with much bigger picture for much longer term. Mr. Li.
Yes, you're absolutely right. Right now, there's huge uncertainty about the future of the U.S. economy, whether the credit crunch that may result from all of these fears of the banking system will push the U.S. into a recession. The markets are already pricing in that the Fed will not be able to continue raising rates to contain inflation. In fact, they might even have to cut rates by about a whole percentage point within the next year in order to contain any kind of shortfall. But we don't know. But you're right, the uncertainty is there. If the fear level is calmed down, then we can come back to the business as usual of getting rid of inflation. But you're absolutely right to point out that the uncertainty will freeze a lot of actions that the central banks in ECB as well as the Federal Reserve would have taken in raising rates. They may slow it down, but the mission of getting rid of inflation is still there.
The market doesn't like uncertainties. Businesses do not like uncertainty, that is for sure. So, Professor Powers, when the uncertainty is there, even though it's just 1 week away, but we all know that the financial sector will not be cried down just within a week. So what would that mean for other economies when looking at the picture in the U.S. and also looking at their own economy? It's going to go back to Ms. Wang later, but go to you first, Professor Powers.
Well, I think if the Fed remains quiet and there's no coordination or statement about where things are going to provide stability, certainly there will be problems and international ramifications. But I think what I would recommend is that the U.S. Fed make it clear that they're going to continue to fight inflation and that they're not going to deviate from that path, and that they're confident because of what President Biden has said, that depositors will be protected, that this banking crisis will not get out of hand. And I believe that will assure investors to the extent possible. But if there is no statement like that or no behavior like that, then I do think we could be in for a rough ride.
Ms. Wang, I want to put the question more specifically to you, because we have just seen China's annual political season wraps up. There's going to be a central financial regulation committee, right, under the direction and guidance of the Chinese Communist Party Central Committee. So there seems to be a lot of thoughts in China about the financial risk and how to manage the financial risk. Now we see an interesting round of what's going on in the banking sector elsewhere in the world, particularly in the US, in Europe right now also. So how do you see the overall picture that Chinese policymakers and also Chinese bankers, including investors as well, entrepreneurs, they should, digest what is going on and try to come up with something that is more reasonable and is likely to be more sustainable? Ms. Wang.
The SVB incident certainly spooked the global financial market and all central banks around the world. And for China, one thing will happen is that the monetary policy is already quite conservative and cautious. In the coming few months, it might become even more so, with a risk-averse bias for good reason, because we're still worried about financial instability. And in China, the financial risks concentrate in two areas. One is the housing market, and the other one is local government debt. Right. So we do not want to introduce a third factor in the banking sector. So the regulators will be very, very careful when it comes to deregulation in the financial market in China.
And today we already see the State Council holding its first meeting on the restructuring plan, but we do not see the details yet. It seems that people are really at this moment trying to digest. Professor Powers, since you're based in Beijing, I'm sure you are also informed about a lot of things going on right now.
Yes, and I would be concerned that this, as Wang Dong has suggested, that this could have an impact on central government efforts to revitalize the economy. That certainly there will be a retrenching, there will be a clear, a careful reconsideration. We're going to see that probably there will be a credit crunch coming from the United States as a result of this. And, you might think, well, maybe this is an opportunity for other countries. But I think actually they are going to be cautious as well.
Right. It is going to be a really closely linked world when we're talking about the financial sector. Mr. Li, less than a year ago, I attended a meeting, a forum on the lessons of the previous financial crisis, including Asian financial crisis. I remember actually the three of you were participating in some kinds of discussions after that with me. So now, when we think about what is going on and the vulnerability that world economy is facing as a result of many things, geopolitics, the conflicts and things going on, what about right now? How should we understand what is going on now with a much bigger picture?
One of the lessons that we talked about when I was at the IMF, and I was one of the editors of the Global Financial Stability Report, was that market surveillance is a critical part of supervising and watching out for vulnerabilities in the financial system. And depositors have to be careful that when they put a large chunk of money into a bank, they have to know what the managements are doing with the bank. The supervisors have to ensure that the system itself is safe, but they clearly have fallen apart in terms of supervising individual banks because of, as Professor Powers said, regulatory capture. These are the vulnerabilities and lessons that we have to repeat over and over again. There is regulatory capture. Market investors must be very careful and do their own due diligence because they themselves are the best protectors of their own money.
If I give you 10 seconds, Professor Powers, what do you think might be the things that we should watch very closely in the next few weeks?
I think that we need to well, in terms of the United States, where this problem has arisen, I think that we need to look at what will the government policies be with regard to fighting inflation and regard to spending. The government has accrued a tremendous amount of debt. There's too much money floating around, and I think that this is kicking the can down the road, as I suggested earlier.
All right. Ms. Wang.
Well, I would be watching with interest on the future regulations for fintech and regional commercial banks. That's the real risks for the US and also for China.
At this moment. Okay, Wang Dong, Michael Powers, last but not least, William Li. Thank you so much, ladies and gentlemen, for joining us. I'm sure we're going to tackle that story in the days and weeks ahead. Thank you so much. That's all the time we have for today. If you'd like to know more, search World Insight or check out our YouTube channel. Follow us on Twitter and Facebook. I'm Tian Wei. On behalf of my team, thanks for watching. Bye for now.